Ballard Co. prepared its statement of cash flows at year end using the direct method. The following amounts were used in the computation of cash flows from operating activities. Anytime you see direct method, first thing you're going to remember is that's generally going to be a question related to operating section. Beginning inventory is $200,000, ending inventory is $150,000, cost of goods sold is $1.2 million. The beginning accounts payable is going to be $300,000 and our ending accounts payable is $200,000. So what amount should Ballard report as cash paid to suppliers for inventory purchases? So what we're talking about here is going to be related to the operating section, but more specifically, we're talking about our cash outflow. When we're dealing with cash outflow related to operating activities, this is generally always going to be related to our cost of goods sold. So we're going to be calculating our cost of goods sold cash outflow. Generally speaking, inventory items are always going to be associated with our cost of goods sold account on the income statement. So we could calculate this by taking our beginning inventory and determining how much new cost we have. So we know that our beginning inventory was $200,000 and our ending inventory was $150,000. So that tells us what? That tells us we have a decrease in inventory of $50,000. Okay, so that's going to be the first thing that we need to know. The next thing we need to know is what is going to be our effect in our changes in accounts payable. Accounts payable are also going to have an impact on our cash outflow to suppliers. So we know that our beginning accounts payable was $300,000 and our ending accounts payable was $200,000. So that tells us we have a decrease in accounts payable of $100,000, right? So that's going to be the next thing that we need to note. So now we can use this information to determine our impact on our cash outflows. So we know that we have a beginning cost of goods sold amount of $1.2 million. And we know that we have a decrease in inventory of $50,000. So what does that mean when we have a decrease in inventory? Well, an increase in inventory would mean that we spent more money to buy that inventory. So a decrease in inventory would do just the opposite. So the most important thing to understand here is we're talking about the amount of cash that we're spending. So a decrease in inventory means that we're going to be spending less. So that means we're going to be decreasing the amount of our cash outflows. What about our decrease in accounts payable? So a decrease in accounts payable means that we're paying off our debt today. So this is going to increase the amount that we're spending today, aka an increase in our cash outflows. So this is going to give us enough information to calculate our net impact on cash outflows. We're going to be able to subtract the decrease in inventory and also add back the decrease in accounts payable. So our net impact is going to be $1.25 million.